If you're a business owner, you already know some of the problems with traditional financing. Banks can freeze your line of credit, SBA loans take forever, and when the economy tightens, access to capital gets harder right when you need it the most. So the question becomes, where do we store capital so we still have control when opportunities or problems show up? In this episode, we're going to break down how successful entrepreneurs use whole life insurance to create liquidity for their businesses. We'll talk about payroll during downturns, hiring, equipment, real estate, and even marketing. We're also going to show you the other side, when this strategy makes zero sense, how policies get designed poorly, and the red flags every business owner needs to understand before putting a dollar into this. So Dom, let's dive in. Our producer Joel has been super kind and really proactive and has put together all the things, all the questions that we'll want to talk about as it relates to setting the stage, as it relates to how we use life insurance. We're going to also talk about the things you need to know, and it's going to even questions about like comparing SBA to HELOCs to high yield savings accounts. So Dom, this episode is going to be a ton of questions. Just know that these questions were put together by our producer, but it wasn't just coming off of his mind. He actually researched what the most common questions are as it relates to whole life insurance and business. And so whether you're an advisor, financial professional, whether you're interested in yourself, like these are the top questions that people are asking. So Dom, before we jump into the first question, what is like your overall thesis as it relates to business using whole life insurance? I'll do mine as well before we jump in, because I think it's important before just diving into question number one to like kind of take a step back and think how you're thinking about whole life insurance when it comes to running a business.
I'm just laughing out loud as you start talking about this, because I was just thinking, I'm like, Joel's probably just tired of us just blabbering about random stuff and ad-libbing stuff. So he's like, you know what, guys? You guys are doing a good job. I need you guys to follow the script, answer some questions, and stop saying that you're the number one growing podcast in the entire space.
I'm sad, man. We're no longer the fastest growing podcast on YouTube. So that's a very sad moment, and not because we got beat, because the producer Joel took that out of the script. He's like, Caleb, you got to stay on script here, which we've already failed at. So we've already failed, and we haven't even gotten started.
We got to have a little bit of fun. All right. So to answer your question, Caleb, I think that the ideation around how one should use whole life in operating a business should really be used as a capital reservation pool. I think for some businesses, for instance, right, one of the first questions says, what type of business / industries would benefit the most from this strategy? And I think that somebody like a real estate investor or just a real estate professional, it's just a natural way that you could use it as a ongoing reoccurrence, because you deploy, you then sell, you get the funds back, you put it back, and then you rinse and repeat. And I think that that's a natural reoccurrence, because they happen in segments, right? You're not going to do it like in a like every day or quick turnaround. You're going to do it like 6 months, 3 months, year at a time. So the transactions make way more sense. But for most business owners, you're really doing a lot of transactions, right? From expenses to going on trips and traveling and taxes and all the things that people do. And now I'm just thinking about that. Real estate investors do all those same things as well. But you know what I mean? You're doing more transactional things like day to day versus more on like a 6 month segment. And so for a normal business owner that's doing lots of transactions, you don't want to use it like a credit card or like a debit card or a bank account. When you need it the most is when you'd want to tap into it, right? It's when I need extra capital that's not used on a normal operational perspective. And so for me, that's what it is. And, for us, that's really how we've even positioned it in a lot of ways, is just letting it sit there and use it for a storage of capital if there's ever been a need that could be used for.
Yeah. I would say 2 words come to my mind. War chest. Those are 2 words, but I was actually meant for 1 word. So 2 categories come to my mind. There's a war chest.
If people don't know, we're recording this video at the very end of the day, and we're tired. It's not an excuse, but we're cranking for everybody.
And then so that's category number 1 is like, hey, if you're a business owner, I believe every business owner should have a liquidity reserve, and I think it should be more than the average employee or just average person individual. So you should have an individual emergency fund, but then if you're a business owner, you should have an additional emergency/war chest to support the business. So that's something that, like for myself personally, I have a personal emergency fund, and then I have a business war chest/emergency fund. And I think that's universal across the board. So there's a ton of businesses out there. Every single business could benefit from having an emergency reserve, and many of them could benefit from having that emergency reserve using whole life insurance for that, because not only is it a storehouse to put money, but by the way, it's also, there's a death benefit, chronic illness rider, you got creditor protections in every state. Some states really good, some states not so great. It's private. So in a sense, you're getting a lot of that emergency strong foundation across the board. So that's one thing. Then for the opportunity fund, this is where you're going to deploy capital, but you're expecting that money to come back. Think through the lens of like an investor. An investor is deploying capital, but they have some type of game plan to get that money back. Whether it's 30 years from now, or whether it's 2 years from now, or 6 months from now, they're deploying capital, and they have a game plan for that money to come back and have it be greater than what they're putting in. That's called a profit, having a profit or a return on your investment. And so for someone like that you're deploying capital, I believe that we're going to break down in this episode that a max funded whole life insurance policy could be a phenomenal place for that. Where it doesn't work out that well is if you are running, like, you shouldn't look at it like like you're running a bunch of money through if it's not really clear about how that money's coming back. So some people, we see people ask us questions about really elaborate, like strategic/complicated models where they're running all their money through the life insurance to pay payroll, all these other things, and they're using their life insurance. And I think, Dom, you and me just like get sick to our stomach, because you're like, number one, it's going to be a nightmare to do, and number two, a lot of times financially, it doesn't make as much sense as they think it does. So we'll break that down. But if you came to really hear like the complicated 45-step breakdown of how we pay our payroll with life insurance, you're going to be disappointed. But if you came to understand like how we position max funded whole life, and as a business owner, how you can think about that, I think you're going to walk away feeling a little bit underwhelmed in a good way, because you might be able to be like, oh, duh, like that makes a ton of sense. And yeah, why wouldn't we have that? But I hate to break it to you. If your business is doing amazing, this is going to be a great bolt-on. If it's doing very poorly, it's not going to be the thing that saves you. It's honestly going to be an enhancer to whatever you have going on. So that's that. Anything you want to say before we jump into question number one?
No, I think that what you're saying is going to fit well with everything that we're going to be talking about. And a lot of them are specifically like the next phase of this is just like, how do we even use it, or what should we use it on? And a lot of them are going to kind of be the same answers in a lot of ways. And so
some of these will be really fast, but we're gonna go through them because we think it's important. If these are the top things that people are searching, it's important that we're the podcast that answers the question. So first question is, why should someone consider using whole life insurance over traditional financing for business?
So is this now where you're interviewing me?
Well, I can answer it. I can answer it. I just didn't know if that's that very interesting if I'm answering all the questions. So
you're like, you're asking and answering, or are you?
I mean, I can take this one because this one's, I think, an easy one. Why should someone consider using whole life insurance over traditional financing for business? So there's two categories. There's going and getting money that you currently don't have, like an SBA loan, other like getting business loans. I put that in a totally separate category than money, access to equity that you have. So if I have equity in my home, getting a HELOC, I'm seeing that as a way to unlock some of my net worth. Life insurance is a form of unlocking some of my net worth. And obviously money in a high yield savings account or checking account is a form of unlocking part of my net worth. So there's two categories. There's access to assets or part of my net worth, or access to actual debt and financing. There's nothing magical about taking a policy loan from a whole life insurance policy that poof creates magical money. This is capital that you've saved, you've paid premiums, and part of those premiums create cash value, and that cash value is available for you to use. But there's nothing magical about it. It's not like there's some crazy arbitrage where you're putting $100,000 of premium and boom, you get $1 million of capital. So I look at it as a more efficient place versus like maybe a savings, or I would rather tap into whole life insurance even than like a home equity, because I have more control, in my opinion, from the life insurance to things like home equity. But that's that category. If you're a business that needs or wants to go find other loans, or even if you're someone that wants to like see if you can set up business lines of credit that aren't based on collateral, those are actually new forms of money. And while I wouldn't want to rely on those, in a lot of cases they're higher interest and a lot of times they're harder hoops to jump through, some businesses they're necessary to do. And I do not think whole life insurance replaces your need or desire to want to get bank financing. You may like the idea of having that capital, just like someone paying off their debt with cash likes that. That same thing could happen with whole life insurance. And so I'm not anti that. But there's nothing magical about whole life insurance that's going to magically eliminate your need to not need to work with banks, especially if your business model or your need is for new money. So whether that's getting new investors or finding bank lending or raising money, those things may still be necessary. Whole life insurance may just give you more options and might get you to a place where you don't need those. But in the short term, it's not a magic fix.
Yeah, no, it's good. The only thing that I would add to that is the flexibility in regards to the repayment schedule for the loan functionality of it, right? And being able to, wait 6 months if you're a real estate investor to make the interest back until you actually sell your deal, or wait until the investment returns to the new employee that essentially turns over and produces a return. Being able to just get charged interest and not actually have to pay that out of pocket from a cash flow perspective can give a lot of peace of mind at the end of the day,
Yes.
knowing that your death benefit will pay off the loan if something were to happen to you. So I would say that that's, in my mind, one of the big perks that I would just add to that. And so,
Totally. Love it.
Okay, so let's move on. The next question is, I think for maybe somebody, I'm going to say a beginner, but this isn't somebody that already has an established business. It's, should you use whole life insurance to start a business? And now the question, I think, is a great question, because most people that are asking this question are starting to think about, like, should I even get a whole life policy in general, right? Likely, if you have a policy already and it's been in force for a little while, there's probably a good chance that you already have cash flow or a business that's already doing extremely well. And so this question probably is coming from somebody who's like, well, should I start a policy and fund it and then use that to start the business? If that's your question, the answer should likely be no. The answer should be, I should only use my whole life insurance policy to start a business if my policy is already established, I've had it for quite some time, and I don't have any other funds anywhere else to start the business for capital purposes. I don't think it's a good idea to have capital saved, put it in the policy, and then it be like, I don't have any cash flow to pay for the ongoing premiums, and the business might not actually even work. And then you're essentially having a problem for lapsing into the future. And so it's all per person. I'd say probably for the more sophisticated person that's had something for a while, maybe, but not to start from the beginning.
So Dom, you're saying if the policy is predicated on the business being successful to making sure that you can pay the premiums, it's almost like taking a very safe, solid asset, tying it to something that statistics are against you. And then if a policy lapses in the first couple of years, we've been very open, you're financially behind, like straight up. Like so I couldn't agree more, is should you start a savings account to start a business? Well, no, you probably should already have a place of storing capital. So whole life insurance and savings accounts and all these things might play a role, but if you're just getting it and you're tying it to a business, especially before you even get started, that you're taking a very safe, solid asset, tying it to a very volatile asset, and as a result, not going to end well. If you're financially really set and you want to have whole life insurance as a place and that can survive outside the business, and you're going to use that capital, potentially invest in a business, but you can make the policy sustain without the business, that could be a separate conversation. But I couldn't agree more. And we actually do have people come to us, and we sometimes that's where we really recommend things like convertible term, because we're like, hey, you're trying to bite too much off right now, and you'd be much better off getting established before you put all this money into whole life insurance, because at the end of the day, we're not comfortable about how you paying for this if you don't factor in risk. All right, so this next question I think will be pretty quick. Can cash value life insurance help cover payroll during downturns or survive recessions? Short answer is yes. We would never set up a whole life insurance policy to say, hey, this is going to be how you're going to fund payroll. Like, that would be a disaster. But like any emergency fund, like any war chest, you name it, if you have the cash value available, of course you can utilize it for things like that. It just shouldn't be built into the plan right away. Does that make sense, Dom?
Yeah, no, for sure. I couldn't agree more with that statement.
Okay,
yeah.
My next question for you is, can I use whole life insurance for employee retention?
You sure can, Mr. Caleb Williams. Here's some ways that one can think about it from a business owner perspective. The quote unquote the golden handcuffs, doing stuff like executive bonus plans. Essentially where like the employer is paying the premium on a policy, the employee owns it, and then the employee gets cash value, death benefit, and then the employer can get a deduction from that at the same time. So there could be some benefits on both sides. The split dollar arrangements, we've had other episodes that we've talked about this, especially with the Charlie Kirk episode. I've had some on the And Asset channel earlier. We're talking about the coach from Michigan and how he's got paid there. Mm-hmm. The deferred compensation. There's lots of ways that one can do payments to your employees to golden handcuff them. And a lot of it is based off of the terms, which makes them want to stay so that they get the benefits into the future.
Yep. You can also do things like buy, sell. So even like for owners or people that are really key to the business, you can do certain things.
But that wouldn't necessarily be like employee retention.
You're totally right. I'm just saying there's a lot of ways that you can blend whole life insurance or any type of life insurance into the employee retention or just business owner retention space.
Yeah, I agree. Glad you brought that up.
Can business owners use a policy loan for marketing? Short answer is yes. I would put this in the same category as if you're going to deploy capital, you want to make sure, factoring in for risk, that you can get that money back. So let me share an example for me personally. When I first started with the And Asset book, I used a policy loan to fund the And Asset book. One, because it's a great story. So I was like, this would be a great thing to say that this helped fund, and it did. Could I have had money elsewhere? Sure, but I decided to utilize my policy. Why? Because it's just a perfect example. That book has now over 20,000 copies sold, printed out in the world, and that book has brought in a lot more money than the initial loan. So if you do the math, I'll just make a number up. Let's say it cost me $15,000 to get the And Asset book out in the world. And just from book sales alone, we've probably recovered that. But the real money has been the people that have read the book that wanted to be clients of ours. So let's just say, Dom, we've made hundreds of thousands of dollars, if not potential millions of dollars from that book. And you could look at the investment of utilizing the policy. Now there's time and other things into it. So it wasn't like a magic wand, but you can see where that math adds up. So that's an example, real life example of how you can utilize your life insurance policy for marketing, but it can return lots, of money. An example where it could turn is you could spend $20,000 for marketing. If you're not watching on YouTube, I'm using air quotes, but that marketing could be a total disaster. If you're a business owner, you know what I mean. A lot of marketing doesn't work out. So you just have to know that if I took a policy loan, a $20,000 policy loan, and my marketing didn't pay off, now I have to find another way to pay off that. And that's just something that you need to know. So it's just like an investment that goes south. Some investments will pay off, some will go to the moon, some will not pay off at all. And that's kind of how you need to think about the marketing space. And so while I would tread lightly, you for sure can use capital to use for different marketing initiatives.
And I think the framework to think about this and all these questions we're asking relative to can I use my policy for XYZ? Ask yourself the question is, if you had a line of credit somewhere else, would you use that line of credit for it? Because when you break it down to a simplistic form, that's really what life insurance is. It is a line of credit. There's obviously a death benefit attached to it, and it continues to grow and compounds. And there's other benefits that come along with that we've talked about on the show. But at the end of the day, like if we're talking about using it for business purposes, for marketing, employees, retention, recessions, it's like, do I need to use a line of credit to deploy for helping my business do X? And if you're like, I have money out the other places, then maybe it's like, no, because you do have a controlled cost that you still have to use to essentially make that work. And so you limit the risk if you have capital other places, versus if you deploy this and things don't work out, you still have to recapture the control costs that you're working with.
Well said.
So for the next question, it's, should you use it to buy equipment? Well, I think in the book, the Nelson Ash Be Your Own Banker, that's like an example that he uses. So I think that it's very clear that you can use it. And I actually think that this is probably one industry, this in my mind is more like real estate, where you'd probably buy some equipment. It's going to take some time to recapture that, the equipment to do its thing, whatever the harvest is, and then the harvest sells, and then you get that back to repay it off. So therefore you have the ability to sit without having to pay the loan back and on your own terms. So I think it's a great place to use it for.
And what I like about that concept is you're buying something like real estate, you have some type of collateral. So unlike marketing, where we've walked how you could make it happen, there's nothing really to like fall back on. Whereas if you buy a tractor, the tractor might depreciate, but you still have some type of value, and if you sell that, then you have an ability to repay. Whereas there's some things that are a lot more fluffy, like a marketing campaign. Next question is, should business owners use their whole life to hire employees? I'm going to say no. don't do that.
Of all the questions on this one, you'd have to know for sure.
Yeah, I wouldn't do that.
That would be, it's...
I guess the only scenario that I would do that for, it's very niche, but if like it's the same idea as if you're in a really competitive environment and bringing a person over would change your business, and you would be willing to go into debt or, to get that person, then you could justify taking a one-time policy loan as a way to compensate. But for the most part, I would say heck no. And if part of your example is using funding whole life insurance and then paying payroll, blah blah, I'm tapping out. I'm tapping out completely and saying absolutely not. You might be laughing, but there's people that show me spreadsheets that are lots of moving pieces, and that's definitely on the playing board. So I'm gonna give my first no of the episode.
Yeah, I think the hard part about employees is we've had many people we've interviewed, and people that have worked out extremely well and people that have not worked out well. And at the end of the day, you think that this person could be your savior, and then they come to be like detrimental at the end of the day. And that's just across the board. Like, you hear many stories. And so even if you think that it's a guarantee, there's just a lot of risk when it comes to people. It's not a mathematical equation at the end of the day. So I would say that is likely why I would say no as well. Okay, so the next question is, can you fund acquisitions with policy loans? Absolutely. I think that could be a great opportunity to do so as well. I mean, it's as simple as that. I mean, you don't even need to explain. So
it's great. Should entrepreneurs leverage whole life insurance to buy and expand their real estate for business? The short answer is, if it's same thing with acquisitions. If buying real estate for your business is something that's going to help further your business, that's the first question. And life insurance has nothing to do with the question number one. Is real estate going to help my business? The second thing would be, where can I get access to money? Let's say, Dom, you had $1 million in your life insurance policy and the building was $1 million. It would be pretty dumb, in my opinion, this is a personal opinion, to drain or collateralize all of your $1 million to fund a now you're like you have $1 million less of dry powder to be able to move or create emergency. For something like real estate, where banks are very comfortable lending against, I would for sure ask for a bank, see if there's line of credit or see if I could get a bank loan, at least get the bank terms. And then you can decide if you're super, super rich and have a ton of money in life insurance and you're like, hey, I'm okay collateralizing $1 million and I might get better rates, great. But I would even pay a higher rate to have the flexibility to pay off that at any time, but have $1 million over here. So when it comes to real estate, like banks won't loan you money when it comes to hiring a key employee or for marketing campaigns in most cases. They might give you a loan for equipment, but it's going to be very expensive. For real estate, you're going to get the best terms because real estate is something that they can value. And so that's something that I would be aware of and look to a bank first and foremost before I just go to my life insurance policy. But having a life insurance policy liquidity gives you optionality, and it might make sense, depending on the numbers, to use some of your cash value to buy down some of the loan or create a more competitive environment.
Amen. All right, let's keep the gravy train moving. So the next one is, what's the best way to track my policy loans for business? It's a great question. And the good part is the insurance companies do a good job, at least on a yearly basis, of sending you statements, sending you reports, showing you what your interest and interest rates are, what the policy principal is. And then you also have apps in a lot of instances or portals that you can log into and see. So one of the other great ways to do so is there are third-party lenders or third-party banks that you can collateralize your policy, where that they can give you a loan against your policy, and they will track all that for you. 1099s, they have portals. There's a lot of ways that it can be used in that way. Outside of that, you're going to have to do stuff manually on Excel sheet. So that's not necessarily my first go-to or encouragement, but if you're definitely that stickler there, that may be a decent way to consider it as well.
I think the exciting thing about AI is, and this is on our docket, it's not high on our docket, but it's to create applications for our clients to better track all these things. And if you can build it in a Google Doc or a Google Sheet, AI can create a dashboard that can help you with all those things. So I think that's the exciting thing, is it's only going to get easier, but everything that you said is 100% spot on. Next question. What happens with my loan if my investment/business goes under or takes a hit and I can't pay my loan? Okay, there's a couple questions here. So what happens if your investment or business goes under? Welcome to business and investing. I can speak from experience, okay? There's not every investment or business idea that I have or do is successful, and it's just the cost of being an investor in a business owner. So that's just kind of like, it should be part of the title. So obviously that's a reality. Now, if you had a policy loan and let's say you took a portion of your policy to put into an investment and it went under, well, it's the same kind of thing if you had money in a savings account and you invested, that money's gone. And so the next question comes back to, okay, you repay that loan somehow, and if you can't repay that loan, and it's just the interest is going to start compounding, and if you get to a point where you can never repay that loan, your policy could be at risk of lapsing. Like we're talking like if you've taken a max loan out, like all of your cash value is collateralized, you put money into a policy or you put it into an investment, it all goes under, and then if you struggled paying next year's premiums, then you're in a trouble because there's no new money coming in. And your cash value is max. So the cash value is not able to really be able to subsidize some of the premium. And so if you're at that case scenario, your policy could lapse. And lapsing, if you if it's in the first couple of years, it is what it is. It just goes away. Just like if your money was in a savings account and you lost it all, it's no longer there. If you happen to have any gain in that policy, then you would have to pay ordinary income tax on the difference between the basis and gain. So if there's $20,000 or $30,000 of gain, that's going to be considered income. That's now going to go on your tax return. So obviously, lapsing a policy is not great, but I also want to just put in perspective, losing money is not great anyways. So then the next question comes down to, you should never be in a situation where you're leveraging your life insurance policy max loan when you're and not able to potentially pay next year's premium, because those are really the only ways that you could lapse a policy. In a whole life insurance policy, as long as you can pay the premiums, you should be good from a standpoint of keeping the policy afloat. But when you're not able to pay the premiums and you're at max loan and not servicing the loan interest, that is not a great situation. And that's something that going to say we've never been in that situation with, because we have a lot of people that we serve, but it's in our big time recommendation that people don't put themselves in that situation, because you could be one decision away from losing your life insurance, and then your life insurance has value too that would be gone if you canceled your policy. But no one throws you in jail. There's no one that comes just tries to collect your money, because technically that loan is a collateral against your cash value. And so there's no creditors that are going to be calling you. So it's not like that, but it's still not ideal, because you could potentially lose your policy if you stretched it that much. Dom, I know I did a lot of talking. I don't know if you want to clear any of that stuff up.
I was just thinking, I was like, man, Caleb does a really good job at it, explaining things in depth and giving like really good answers. There's not even anything I could add to that, even if I wanted to. So we can,
let's move on. If you're confused, that's okay. The cliff notes is don't take a full loan, and that's the disclaimer. Is always have at least 1 to 2 years worth of premium in your cash value at all time. From personal experience, just by being in business, we've served thousands of people. You have at least 2 to 3 years of base premium in your policy in cash value available. In most cases, almost every case that I can think of, you'll be able to do what's called land the plane, and it's a night and day difference versus tapping all of that freedom out. So that's what my thoughts. But why don't you go to the next question?
Amazing. I love it. Okay, I love you, man. I love you. Let's see. All right. How fast can you access the cash, and how much can I access in year one? This is going to be dependent on the carrier and the policy designs. So not all carriers actually allow you to take cash value in the first year. There's some carriers that we won't allow you to take it, period, for quite some time. And so it's very important that you work with a carrier that does allow you to take it sooner if you want access to it sooner. So that's the first thing. We work with all the carriers that do allow access within the 30-day window. I've seen it as soon as 15 days, but I like to tell people 30 days. You just want to make sure that you give some buffer there. And the other thing is, it's like, how much can I access? Well, if you design it in a way where there's no cash value, well, then, you can access none of it because there's nothing there. But if you design it in a way that it's optimal for cash value, depending on if you're funding it within a front load scenario or a cash flow scenario, and front load is a large lump sum in the first year, or an ongoing payment, or an ongoing payment where there is no front load the first year, you can see anywhere with design for the way that we do, anywhere from probably 70 to 92%. I know it's broad, but it really does come down to the company you work with and your age, your health, your gender, and some of those factors. So let's say 70 to 92% within the first 30 days is the answer.
Yep. And conservative number on that is whatever your cash value is available. You can usually have access to 90 to 95% of that number. So if you have $100,000 of cash surrender value in your policy, you could have access to up to that 90, 95 $100,000, and again, that would go against my rule up above. So don't do that. But you have the ability to do that. It's just Dom and I don't endorse that. All right, next question: are policy loans taxable? No. Should I elaborate? I don't know if I've ever answered a question with one word. They're not taxable, and that's one of the reasons why life insurance can be such a powerful asset. But for the record, all loans right now aren't taxable. So this is the same strategy that people like Elon Musk and Jeff Bezos and others have. They pay themselves a very small salary, but they lend against their massive net worth. So it's not anything crazy new. So loans are not taxable. That can be very strategic, especially when you think about the buy, borrow, die strategy. The other thing that I want to just mention is paying back loans for business purposes. There could be an argument that the interest is tax deductible. Now, you'd have to talk to your CPA and tax professional. You may have to set up a third-party lender to make it more clean. But there is a world where if you take a policy loan for business activity, that you could write the loan interest off as a business expense, talk to your CPA, and there might be more details, but that could also be very strategic when you're looking at like the pros and cons between using life insurance versus using a checking or savings account.
Yeah. Again, has to be very strategical. Don't try to have a personal policy, taking a loan and then using it for a business expense and then say it's deductible without actually doing the proper paperwork around it.
Yes.
Because there is paperwork and things that need to get signed off and assigning to the LLC, things like that need to get taken place for it to be official.
If you're a high-earning professional, entrepreneur, or someone who wants more control of your money, we offer something called a clarity call. It's a one-on-one conversation where we learn more about your situation and walk you through how integrating whole life insurance could help better your financial situation. It's no pressure or fluff, just real clarity on whether this strategy is right for you. Click the link in the description or tag comment below, and we'll walk you through exactly how we can help you.
All right. So what are the interest rates typically like? I'm assuming we're talking about whole life insurance. And so if we weren't talking about whole life insurance, we'd be all over the map. And honestly, I'm going to go all over the map because I think it's a good thing to talk about because it gives you the visual on how powerful whole life insurance really can be, especially in today's interest rate environment. So the current prime rate is 6.75%. So whole life insurance policies loan rates are usually close around there, usually a little bit less or so. So right now they're right around 6%-ish is what you can take a whole life insurance policy loan on. Now, that's going to vary depending on the carrier, direct, non-direct. There's some other factors that go into that, but that's probably right around where it's at. If you look at other rates that are out there in like today's environment, you're going to see they are always higher. Obviously, credit cards, we know that they're in the high 20%. But when you start looking at HELOCs and lines of credits, like even today, right now, they're closer hovering around like 10%. And so that is another beautiful reason why having whole life insurance for business or investing, real estate, et cetera, is just another asset that you can have for borrowing purposes is because you will always have the cheapest rates that are out there on the marketplace just by sheer association of how whole life insurance works. So with that being said, they're currently that. And today is, we're at the close to May of 2026. So that's obviously, if you're watching this at a different time in the future or early, I think rates will change.
Time of this recording, the lowest life insurance policy is 4.5, which is crazy low. And then I think the highest is 8. And obviously there's a lot of stipulations that come with that. Some are direct, some are non-direct recognition. So it's not as black and white, but that just goes to show that those are pretty attractive. And if you go one step further, okay, why do you get a better rate with real estate versus a non-collateralized loan? It's because it's less risk for the lender. They're like, oh, Dom, I'll give you a better rate because I have real estate to fall back on. Well, life insurance line of credit is even safer than the real estate because real estate can go up and down. You know, it's somewhat solid, but can go up and down. Whereas your life insurance built, especially with these, mutual life insurance companies that are massive with strong ratings, the bank's like, I'm taking almost zero risk, pretty much zero risk. And that's why if you take a third-party lender, they're going to give you super attractive rates. And the insurance company is already on the hook for your death benefit anyways. And so they are almost taking zero risk because they have already baked that risk in. And so just whether you work with an insurance company, a third-party lender, you usually understand that cash value collateral is very attractive, hence why you can get really attractive rates, and hence why you don't have to necessarily repay those back because the insurance company is on the hook for both your death and interest rate, so they can hedge both sides and they can play long-term games. Regular banks don't want to play lifetime games with people. That's why they require you to have some type of interest payment or principal and interest payment as you make those loans. So now we're going to go into the different comparisons on like whole life insurance versus business lines of credit, whole life insurance versus SBA loans, whole life insurance versus HELOCs, and whole life insurance versus a high yield savings account. I think early on we mentioned like your SBA loan is something that is totally separate. I wouldn't put an SBA loan and compare it to a savings account because I would just put them in two separate categories. And so no problems with SBA loans, but I just see it as something totally different category. So I'm not anti-SBA loan. If you can get an SBA loan, great. It doesn't make or break whole life insurance. And I think if you have enough capital in your whole life insurance, I would still look to see if you could get something like an SBA loan for optionality. So that's myself personally, because I could always tap into my whole life / savings to pay off the SBA loan, but I'm just creating more pools of options with that. So that's, and there can be some really powerful potential forgiveness if you go down that route. So that's one thing. A business line of credit versus HELOC. Let's tackle HELOC next. How would you go about the whole life versus HELOC conversation, Dom?
Yeah, they actually have a lot of similarities when it comes to the ideation of how they work. And that's why I was mentioning earlier is all of them at the end of the day, they're lines of credits, right? And this is why we're comparing them. Your home on a HELOC gets to be the collateralization, and your whole life policy, the cash value, et cetera, like there's the collateralization there with the death benefit, all of those fun things. There's approval processes with the HELOC. The rates are variable with the HELOC. The amounts are going to vary, depending on the equity that you have in the home. There's a strict repayment structure. So you can see that there's like risk, maybe you can get it, maybe not. Like there's some dependencies around that. The good part is once you qualify for your whole life insurance through the health process and you have that and it's locked in loaded, there becomes very, very minimal in regards to some of the moving pieces. You don't have to get approved anymore. The amounts are going to keep growing and compounding regardless of what the market's doing. You have the repayment schedule to be flexible on your own. And so it's the only difference is likely when you're looking at this as well, like early on, you're going to obviously have a massive line of credit if you're doing a HELOC, and then your whole life policy will take time to compound over time. And so when we're just looking at the sheer art of how they function, the whole life has a lot more benefits than a HELOC, but that doesn't necessarily mean one's better than the other. They're both different tools that you could use them at different times of your life, different seasons. And like I say, like why not use both?
Yeah, I would use both. Right now, I don't have enough equity in my home, but when I do, I will have a second lien HELOC that I would use as another source of capital, and I would pull from whatever interest rate's more attractive. Sorry, guys, that's just the logical way, the right way to go about it. So that's what I would personally do, and so yeah, I think that was well said. Whole life versus business line of credit. I'll just go off of like what business line of credit looks like for us. So our bank gives us a business line of credit because they see let's just say the healthy nature of our business. We've always paid all of our business credit cards and all. And so we had, I think Amex come to us and give us the most attractive business line they have with the best rate kind of deal. And it's something that we're not currently using. But again, it's better to build a well before you're thirsty. So we have that access. It's actually not great. It's not terrible. I think it comes out to like a under 10% loan. It's kind of like a monthly, it's kind of a weird calculation. So it would be something that I would be open to, but I would prefer to tap into my life insurance before that, because again, I can have cheaper access to money. And as long as I have that business line of credit, I could potentially be able to use that to repay back the life insurance loan. It is not like best case scenario. I'm just letting you know, like when you're dealing with revolving debt, I'm very open to, okay, what's the more convenient, cheaper access, because I could take one line and pay off the other if I wanted. It's not necessarily like best practice, but I could do that. And so that's what I would say as it relates to that. If you can get business lines of credit, do it. But if it just comes down to what's the best place to access money, and it might be that, business lines of credits can come and go. So you may want to decide to tap into that first. And then if it gets foreclosed on, you can use your savings or whole life insurance to potentially pay that off. So just know that not all are created equal. And if you look at your business line versus a whole life insurance cash value, like one is rock solid secure, one could be called and pulled at any time. You have to factor that into the credibility of the money. But yeah, that's what I would say as it relates to the business line of credit.
Amazing. Do we only have this last question, which is the whole life versus
whole life versus keeping money in a high yield savings account? And I could do a whole episode, maybe in the future I will, on a calculator that I built. It's like, you wanna see my calculator? And I
that's funny.
I don't know what to say other than short term savings accounts can be great. Long term, if you're thinking 15, 20, 30, 40, 50 years, and yes, most people will have bank accounts for over 50 years. Not that they're storing money in their bank for over 50 years, but they're flowing money through their bank over 50 plus years. What is the opportunity cost of not maximizing the dollars that flow through that system? And person A who does a savings account will get things like, it'll be super convenient. They'll have access to their money, but like overall, your savings account doesn't give you a death benefit, doesn't give you special illness riders, doesn't have creditor protection, pretty much gives you pretty low interest rate yield if you compared to other scenarios. So you start stacking that up, it's like, okay, person A is using it for convenience. Person B is putting their money into whole life insurance is maximized. In the first couple of years, person B is actually behind person A when it comes to access to capital. Like person B has less money than person A, but over time, their money not only grows faster than person A, but they have all the other benefits. They have a death benefit that's growing. They have a critical and chronic illness riders that benefit is growing. They have better creditor protection. All those things are growing in addition to them having a greater yield. So long term, person B has a greater yield that's pretty much tax deferred. They can access it tax free. So they have better tax advantages with a better yield and a death benefit and all these other benefits that they get. So person B long term is going to have a ton of benefits. And when you compare apples to apples, when you truly compare, like person A might have more convenience, but they have less benefits. And you factor in those benefits that they're foregoing, person B, who has the life insurance, is going to be ahead by 1 to 2%. And so it comes down to 1 to 2% doesn't feel like a lot. It really isn't. But over 20, 30, 40, 50, 60, 70 years, a 1 to 2% difference on how you're storing and using your money adds up. And that's what I would just say as it relates to that is short term, savings account all day long. If you can think more long term, I think life insurance makes a ton of sense, and every year will even make more sense. I don't know of how many assets that you can really say that with confidence. And the life insurance conversation, you can say that with confidence.
It's good. The way that I would end that is life insurance has 15 plus benefits that can come with it. And a high yield savings account has 1.5. And the half is the growth rate. The one benefit is the liquidity and easy access.
Yep.
Outside of that, there's not that many utility use cases that you can say that it's for, which is a very important one. All right. I think that it needs to be obviously part of everybody's portfolio. But when it comes to life insurance, it just gives you more bang for the buck. Has high equivalent value, has high benefits. Caleb's over there like, that's my calculator right there. He's just
Someday I'll show you my calculator. Maybe if you guys
amazing.
like and comment, I'll show my calculator. I do think it's important, Dom, before we go into Q&A, to walk through a couple considerations, but we can just go through them really fast because since we promised that in our intro, I think it would be important before we land the plane to just walk through like what people should look to avoid and how whole life insurance could go really badly if it's not set up well. All right, so here are quick questions that we can go through. So how is whole life insurance commonly designed poorly? I would just take this really quickly. Especially when it comes to business owner use, a lot of times it can be people that are having super high bases, which having a high base is not necessarily a bad thing, but it gives you less flexibility, less initial cash value, and longer break evens. And what I mean by that is it takes longer to have more money than what you've put in. And so in business, sometimes flexibility and access to capital are really important. And so they read like my book or Nelson Nash's book and they like get the concept, but then they design a policy that's not very flexible and doesn't give you much cash value and takes 10 plus years to break even. Like that, obviously it's like the concept's right, but the policy setup wise isn't really great. And so, I mean, we could go way more into detail, but that's what we see most commonly is people being pitched around this concept of life insurance. They're on the same page, but then it just doesn't result in a policy that's really attractive or optimized for what they need. And a lot of times they value higher liquidity than maybe their policy is designed for.
Yeah, no, that's good. And if we're talking business purposes versus personal purposes, I think it's a different conversation. But since we're having the business conversation, you could argue on the other side of having a policy that's sheer for liquidity and doesn't talk about the death benefit not being good and being a designed policy, especially if the benefit is supposed to pay out for a buy-sell agreement. Somebody dies and needs to cover the other.
You read my brain. You literally read my brain. I was like, if you set this up as a buy-sell and you maximize cash value and the death benefit was super low, but the death benefit was supposed to pay for the business and the buy-sell, that is the example of how optimally designed is the exact opposite and doesn't fulfill and actually potentially could make you worse off. So that's where it's just really, really important to figure out what your goals are. And then a properly designed policy is supposed to optimize those goals. So I'm glad you mentioned buy sell because I was literally going to mention that. And I'm like, oh, you beat me to it.
Oh, amazing. All right. Well,
what riders matter most? I mean, paid up edition rider, I think a term rider is almost essential in a lot of these. So like paid up editions create cash value. Term rider can artificially bump up death benefit to potentially create more cash value. I don't know if there's any other special riders that you would want to factor in. And if you're talking to our team or someone that really knows what they're doing, all these things should be like a no-brainer. A waiver of premium is an optional rider that you could look into. That's essentially that the insurance company will pay at least the base premium if something were to happen to you, like you were to get disabled. You would want to compare that to getting like a DI policy, and you could look at the pros and cons. Some people decide to get it, some people decide not to. So those are things that you could look at. But I don't know, Dom, if there's any other like riders that jump off the page for you that you're like, hey, you got to make sure that you get this.
No, I mean, there's like a zillion riders, especially when you start talking about traditional life insurance and term insurance and other things like that. But I think for the basic premise of what we're discussing and talking about, I think what you shared and mentioned is plenty. I know some offer like a long-term care rider as well, which is very, very close to home for a lot of people. It's something to consider.
Yep.
But in general, if you're coming for higher cash value, the things that Caleb mentioned, I think is right on par.
Cool. Okay, last question is, should business owners use index universal life for this strategy? And it really comes down to you're using this as a foundational asset for your business. Would an index universal life policy make sense if you're a business owner and wanting to see if life insurance could enhance your business endeavors?
I would say the answer is no. And I don't normally give black and white answers, especially when it comes to IUL in a lot of instances, because I always say that it depends on the person. But we're going to pretend that this use case is a storage of liquidity to be able to borrow against for your business when needed. And when needed is very important. And in IUL, in majority of them, you lack liquidity early on because there's surrender charges, there's fees, just the way that the commission structure is set up, and just the designs as a whole are meant for long-term performance and not early cash value usage. And so then you start to add other risks involved of like, well, the market might be down, so therefore I didn't get any policy growth, but guess what? We had a recession, so I need to pay my employees. Wow. So your policy didn't grow. I need to pay my employees. I don't have any money. Now I need to borrow and take a loan rate of 6, 7, 8% against my IUL, because a lot of the times the loan rates are a little bit higher. I am putting a lot of risk into one segmentation when life insurance is supposed to give you a buffer of volatility and make things give you more peace of mind when you need it the most. And so I would say that that's not a very good use case if this is what we're trying to accomplish.
All right, Dom, this next question I think is important, and it comes down to how should someone plan to hold their policy? Should their business hold it? Should they hold it personally? I know we advocate a lot of times that business owners should actually hold their life insurance policy personally and not have the business. Sometimes that can be confusing, but break down why we recommend in most cases people hold their policy personally, but they can still use their cash value for whatever they want, including their business.
Great question. I think that when people are looking at this this concept, the ideation of putting it inside of an LLC or something like that sounds very attractive, because you think that because it's in an LLC brings lots of benefits, right? You have the protection, it prevents you from getting sued other places, et cetera. Well, life insurance as a whole already has a lot of natural benefits built into it, whether it's like creditor protection and lawsuit protection and tax. Like there's already really solid benefits that come within life insurance. And so by naturally putting it and owned by the LLC doesn't give it any extra benefits from the protection, from the veil that's essentially saying your personal side to the benefit side of the business, et cetera. And so what you're doing is you're just creating more complexity for no reason at the end of the day. There's more questions, there's more validations, there's more upload, there's more, they'll ask more questions about the business in regards to P&Ls, revenue. Like there's other things that get involved within that could even limit the amount of coverage that you could get in theory, just depending on what the P&L looks like and other things like that. And so business use cases should only be when you're using your policy specifically and only for business purposes. You don't want to have a business policy, but then you need a personal usage of, hey, I needed to go on my family's vacation, or I need to have an emergency because my house, is flooding, or I'm just making the random thing up. You obviously don't want that to be a quote unquote tax nightmare as well when you're starting to think about how this works, right? So keeping them personal, and then what we talked about once upon a time, if you're going to use it for business or real estate, et cetera, talking to the CPA and working through an agreement between you and your business was a much easier, safer way to not create complexities down the road for yourself.
Yeah, well said. Well said. Nothing I need to add there. Thanks for breaking that down. Another question is like, how much money should I have before I start a whole life insurance policy, especially in the context of business? If you're a business owner, I would say I would have at least $20,000 that you can put in for the first year. And if you can't fund more than $10,000 ongoing, this strategy would not make sense for you to consider. You should just get term insurance that's convertible and get to a point where you can do that. The reason I say that is business is going to come with lots of unknown punches, and the last thing I would want is try to get you to like stretch, because I would actually answer that differently if I'm not talking to a business owner, but there's more risk and volatility that comes with the business. And so, that's my answer as it relates to that. Doesn't mean you shouldn't have insurance. Everyone should have their human life value in insurance, meaning like if you're worth $4, $5, $6 million on paper, you at least should know what that looks like to insure that or cover that, but doesn't mean that permanent life insurance is the right fit for you. So that's what I would say about that. We talked about how you should hold your policy, what type of person benefits most from the strategy. I think we've covered that. What income level makes, I think for an entrepreneur, it makes more sense about how much capital you're sitting on and ongoing. So, I think if you're making less than $100,000 a year as a business owner, that's another area where it's like maybe you get term insurance and give yourself the ability to do a strategy like this, because there's a lot of potential ups and downs that could come. Now, if you're in a super established business, totally different than if you're just getting started. So all of this stuff is with a grain of salt, but it's, and if you're in certain parts of the country where, $100,000 goes a lot further than others, that's another aspect that you should consider. But there can be a lot of expenses that come. Dom, I think we've covered it all. I don't know if you have any final thoughts, but I see this as a war chest / emergency. And then you have your opportunity fund. If you establish as a business owner that I want, let's say 100,000. I gave advice the other day to someone that I'm coaching, and our goal is to build up $100,000 of emergency, and then everything and above that. Now we can talk about places to deploy that. But 100,000 is like the line in the sand of like we're establishing that, and they'll be able to knock it out really fast because of the type of business they're in. But that it just goes to show like that for them was the number. For me, it's a little bit different. But you create that emergency fund / war chest. Everything else is now an opportunity to grow the business, make moves, but ultimately use that capital like you're an investor in your business, because your business is actually an investment. So that's kind of my summary. I think it's a phenomenal strategy. It's a great foundational asset if done properly, but hopefully you appreciate that we're not trying to overhype or oversell something, because it's not a magical fix. It's not the thing that's going to help you get your business off the ground. If your business is failing, it's not going to be that magic thing that saves it. And in fact, it might not even be the number one thing that you want to tap into, because there might be more efficient places to get money, hence potentially getting a loan for real estate and cars and other things to free up your capital in your savings account, your emergency, in your life insurance or your HELOC. So that's kind of my summary of this episode.
Well said. I think that's how we can end it. I know this episode is a little bit longer, but lots of golden nuggets and that I think can be taken away if you're a business owner. And so With that being said, if you are a business owner and you're on the fence about getting a whole life insurance policy for yourself or not, well, feel free to click the link below, talk to our team. We'd be more than happy to have just a conversation on saying, this isn't for you. This is for you. You need to save more money. You have enough capital. Like we'll be have real honest questions, ask real honest questions, and give you real honest feedback in regards to where you're at. So with that being said, thank you again for staying tuned. If you watched it all the way to the end here, you are absolutely amazing. God bless your heart, and we'll talk soon.